Hi, you're watching Market Cafe on ET Now with me, Shreyanti Singh and Kanishka Sarkar. And over the next 1 hour, we'll get you updates from within the country as well as across the globe. Also tell you which stocks you should be keeping on your radar as well. But speaking of stocks and Kanishka, let's get a quick check going on what the US markets are doing. And it's been a slide that we've seen thus in terms of the last week and this week as well. You did have Trump's tariffs rattling stocks on Wall Street. Tell us a little more.
Absolutely, Shanti. First of all, a very good morning. Speaking of stocks, well, Trump's tariffs-related announcement continued to spook stocks on Wall Street for the third straight day. In fact, yesterday, US President Donald Trump threatened even higher rates against China if the Asian nation doesn't withdraw its 34% tariff. Yesterday, the Dow Jones Industrial Average dropped about 350 points. That's nearly a percent. In fact, during the session, the Dow fell more than 1,700 points to the session low and then swung nearly 2,600 points from the low to high in a record reversal. The S&P 500, on the other hand, shed 0.23% after it briefly entered the bear market territory during the session, but was last off nearly 18% from its recent high. Now, the tech-heavy Nasdaq Composite inched higher by 0.10% as investors stepped in to buy some mega-cap tech stocks such as Nvidia and Palantir. As its low in the session, the tech-heavy index was down more than 5%. In fact, the stock seemed to have mounted a short-lived rally at one point that took the Dow Jones Industrial Average into the positive territory. This could have been on the back of speculation of a tariff pause that was circulating on social media. However, the White House has said that any talk of a 90-day pause was fake news and that major averages retreated once again. Now, if you compare the market's performance at the time of the pandemic to now, the S&P 500 has lost more than 10% in the last 3 sessions, which is its worst stretch since the outbreak of COVID in 2020. Now, despite the sell-off, the White House has remained defiant, reiterating that the set of shockingly high tariffs unveiled on Wednesday evening would take effect on April 9th as scheduled. Now, while China retaliated on Friday, other countries seem to be readying their own counter-tariffs. Now, other than stocks, US crude oil losses also seem to be deepening on recession fears, Shreyanti.
Absolutely, when you take a look at crude at this point, you do have a slight bit of rebound that we saw at least during the session. But when you take a look at prices overall, you did have prices falling about 2%. In terms of factors, you do have the same set of factors that we've seen thus far also making a comeback, and namely you do have global demand concerns that have been highlighted by this tariff tantrum. At this point, you do have steep losses being added to at this point on the fears that President Donald Trump's global tariffs are going to be pushing the US and maybe the world into a recession. And that is definitely something that we're looking at in terms of US crude oil, 2% downtick. They're about $60 per barrel is the kind of level that you're looking at. When you take a look at Brent as well, about a $1 downtick or 2% downtick coming in for Brent as well, and below those $65 per barrel levels is where Brent was also at. And the latest price action, remind you, comes after US crude and Brent closed down more than 10% last week. So it's been quite the slide, and adding on to those steep losses was last session as well. And in terms of other factors, of course, you do have OPEC commentary coming in, and you did have the decision by key OPEC plus producers as well to increase the pace of production hikes. That's also something that we're looking at. In terms of patterns, as far as crude is concerned, you do have a very important pattern in terms of contango. That is something that we're seeing a little bit of at this point. It's a bearish pattern where the difference between the two spreads is getting narrower, and that is something that we're seeing at this point as well. So largely that's the kind of handover that we have. Let's see if a technical rebound is on the charts when it comes to crude as well.
Absolutely. Now, moving on, let's get you some cues to watch out for today. Well, back home, the 2-day RBI policy meeting kicks off today. In Japan, current account data is set to be released today. Now, in terms of corporate action, Maruti Suzuki is to undertake price hikes today, so cars are expected to become expensive. In terms of other events, San Francisco Fed President Mary Daly is expected to speak later in the day, so that's some key commentary expected from the US.
Absolutely, some key commentary definitely expected from the US, but moving on, then it was a wild ride for Wall Street yesterday. Media houses misinterpreted a top official, Kevin Hassett's interview when asked Trump would call a 90-day timeout. In fact, Hassett said that the president is going to be deciding what the president is going to decide. However, some users also claim that this meant that there would be a 90-day pause, sending stocks higher before the administration clarified that it was just fake news and there is absolutely no delay in tariffs as of now.
Moving on, well, just hours after China issued a sharp rebuke to the West, declaring that threats and pressure are not the way forward, US President Donald Trump has launched a fresh offensive in escalating the tariff war. In a late-night post, Trump threatened a new wave of punitive tariffs on Chinese imports, demanding that Beijing roll back what he calls an unfair 34% levy, giving China just 24 hours to comply. And the deadline, April 8th, the message clear and uncompromising. Now, this dramatic ultimatum has sent shockwaves through global markets and raised concerns over the future of US-China trade ties. Now, let's go across and listen in to that excerpt.
With China, as you know, against my statement, they put a 34% tariff on above what their ridiculous tariffs were already. And I said, if that tariff isn't removed by tomorrow at 12 o'clock, we're putting a 50% tariff on above the tariffs that we put on. So they've gone for years. They've become a rich country because of people, again, that were in the White House that allowed this to happen. Hundreds of billions of dollars a year they'd make on us on trade, and it shouldn't be that way. And I have a great relationship with President Xi. I hope it's going to stay that way. I have great respect for China, but they can't do this.
Coming in from US President Donald Trump as well. But moving on, China has in fact responded once again after Trump's threat of imposing additional 50% and up tariffs on the country. The Commerce Ministry in fact said that Trump will be making a mistake on top of a mistake and urges the US to immediately rectify its wrong practices. In fact, in a sternly worded note, the ministry has said that it will never accept US blackmail.
Well, moving on, it seems we would have to brace a long haul as tariff talks could stretch into the summer. US Treasury Secretary Scott Bessent said in an interview that he's surprised by the market's impatience, calling Trump's sweeping tariff just the opening move. Now, with nearly 70 countries reaching out, Bessent says that Japan could get priority and that negotiations may run into June.
Moving on, is the US already in a recession? BlackRock CEO Larry Fink seems to think so. In fact, speaking at the Economic Club of New York, Fink said that most CEOs I talked to would say we're probably in a recession right now. One airline CEO, in fact, even told him the canary in the coal mine is already sick. Fink also warned Trump-era tariffs could be fueling inflation as well as rule out Fed rate cuts at this point. He also sees zero chance of 4 cuts this year.
Well, another billionaire lashing out at Trump's tariffs. GOP mega donor and Home Depot co-founder Ken Langon isn't holding back. In an interview, he called the 46% Vietnam import duty, and I quote, bullshit, end quote, and slammed the 34% China tariff as too aggressive and too soon. Now, he says Trump has been poorly advised and that he does not understand the formula.
Moving on, Europe is clapping back. The EU Commission has proposed 25% tariffs on a wide range of US imports from motorcycles to poultry in retaliation for Trump's steel as well as aluminium duties. However, bourbon breathes easy for now as whiskey is off the list, but EU member states are ready to hit back hard starting May 16th.
Next up, Benjamin Netanyahu and Donald Trump seem to have had a fruitful meeting, as of now at least. Israel's ready to deal, however, Trump's not budging yet. Netanyahu vowed to wipe Israel's trade deficit with US and tear down trade barriers, but Trump isn't pausing tariffs even against its closest allies. All he said was, maybe not, citing billions in US aid to Israel instead.
All right, then moving on to news and updates back home, then Piyush Goyal, Union Minister of Commerce and Industry, speaking at India Global Forum, expressed his concerns over the massive fall in markets, also spoke on the trigger point, China, as well as prevailing economic condition. Let's go across and listen in.
We stand in very difficult times. The world is going through a turbulence. I just saw a chart earlier in the day giving me the last 24 hours of stock market performance across the world. Fortunately, India was right at the bottom, some 3% down or something, compared to the chart starting from about 9% plus, or rather 9% down, to put it more correctly. So these are going to be challenging times. These are reflective of a world in turmoil which has, over the past many decades, built itself to reach this stage. Obviously, these things don't happen overnight. These things are a culmination of several factors at play. And if somebody was to ask me what would be the trigger point of where we are today, why the world is going through this churn, and what I believe, and I have been able to assess, the starting point of this actually goes back to the beginning of maybe 2000 or 3 or 4 years before that, when China was admitted as a member of the WTO. And maybe around late 90s or mid 90s when they got into conversation with the WTO. And collectively, everybody in the world accepted China as a member of the WTO. Many parts of the world were convinced that China will reform itself, China will transform its processes, will bring transparency to their economy, will work on fair terms in the global economy, and that being a large economy, an emerging economy, an economy growing by leaps and bounds, and we've seen that growth over the last 25, 30 years, almost relentless growth to become the second largest economy in the world. But what everybody closed their eyes to was that this growth was fueled by unfair trade practices. This growth happened at the cost of fair play. This growth had its foundation on every action which, in the rules of the game, would be considered improper, and the result of those actions caused a situation where I think large parts of the world got carried into the narrative of low-cost manufacturing, low-cost goods coming from one particular geography, but did not realize the long-term impact that it would have at the global stage.
Well, that's the commentary coming in from the Commerce Minister as far as the market sell-off is concerned. With that, it's time to take a very short break on this edition of Market Cafe. See you with more news and updates on the other side. Don't go anywhere.
Welcome back. Thank you so much for staying tuned in. Let's also take a look at the Asian markets to begin this segment. Then, firstly, let's take a look at Japan's Nikkei. Of course, you do have Asia Pacific markets opening high, rebounding from previous sessions' losses. And Japan's Nikkei is the one where you're seeing the gains more pronounced at this point, 6.6% uptick coming in as far as Nikkei is concerned. When you take a look at Hong Kong's Hang Seng Index as well, uptick of about 1.9%. There you have it on your screens as well. Kospi as well, 1.4% uptick coming in. As far as South Korea's Kospi is concerned, now of course it's flip course, currently down 0.6% as we speak as well, holding on to a tinge of red at this point. But can't say the same about ASX 200 because that is also up over 1.5% gains coming in for ASX 200 as well. Shanghai as well holding on to a little bit of green at this point. So uptick of 0.3% thereabout coming in as far as Shanghai is concerned. So at this point, only just the Kospi that's holding on to a tinge of red. Let's see if that also manages to recover because that was previously in the green to kickstart the day as well. Nifty, of course, shut shop at around those 22,160 levels thereabout. And currently, what is being penciled in is a gap up open, a very solid recovery, a very strong recovery is something that we're penciling in. A very good handover as far as the Asia is concerned, barring Kospi, of course. So let's see how that pans out for us, Kanishka.
Absolutely, a very positive handover coming in from the Asian markets. Welcome back to ET Now. You're watching Market Cafe with me, Kanishka Sarkar and Shreyansi Singh. Well, now let's get you some updates on the domestic front. Well, the central government has raised LPG cylinder prices for both subsidized and non-subsidized categories by 50 rupees per cylinder. Starting today, domestic LPG cylinders will cost 550 rupees for Ujjwala beneficiaries and 853 for non-Ujjwala beneficiaries. Now, meanwhile, the centre has also increased special additional excise duty on petrol and diesel by 2 rupees per litre. However, the government has clarified that duty on petrol and diesel will not be passed on to customers. Listen in to Union Oil Minister Hardeep Puri on this.
Average price, not the average, the price per cylinder of LPG will increase by 50 rupees. In other words, from 500 it will go up to 550 and the other one will go up from 803 to 853. Now this is a step which we will review as we go along. As it is, we review these every 2 weeks or 3 weeks. And therefore the excise duty that you have seen increase is not to go on to the consumer on petrol and diesel. As I kept telling you, that excise increase is intended to compensate the oil marketing companies for the 43,000 rupees, 43,000 crore that they have incurred as a loss on the gas part of it.
Other than there you have it, that's the word coming in from the oil minister as well. Let's move on. Let's get Prakash on board, joining us with more details. Prakash, why has the government increased the central excise duty? In fact, help us with a few more details there.
The hike in central excise duty on petrol and diesel will essentially take excise duty on petrol to rupees 13 per litre and diesel to rupees 10 per litre. That's an important development coming in as the government has decided to increase central excise duty on petrol and diesel by rupees 2 per litre despite the fact that crude oil prices are hovering around 60 per dollar in the international market. And there were some expectations the oil marketing companies will provide some sort of relief to the consumers in terms of reduction in petrol diesel prices. But the government has decided to increase central excise duty on petrol and diesel. But it has made it very clear that the burden will not be passed on to the consumer. In fact, the burden of hike in central excise duty on petrol and diesel will have to be borne by the oil marketing companies. Along with that, the government will collect roughly around rupees 32,000 crore by this season, and the amount will be utilized to compensate oil marketing companies to cover their losses they are facing on sale of domestic LPG, which is roughly around rupees 41,000 crore. In addition to that, the Petroleum Ministry has also decided to increase prices of domestic LPG by rupees 50 per cylinder, and that will be applicable for Ujjwala and non-Ujjwala customers both. As you are aware that the oil marketing companies have been requesting government to compensate them to cover their losses they are facing due to sale of domestic LPG below market price. Now, interestingly, government has come out with some sort of formula where the government has decided to impose central excise duty on petrol and diesel being sold by the same companies to compensate them.
Well, that's as far as the LPG prices are concerned. Now, Prakash, when do you expect consumer to get respite in terms of petrol and diesel price reduction? Now, we understand that customers will not be burdened with the increased prices and that OMCs will have to bear the cost. But how does it impact the margins of OMCs?
Yeah, that's a fact that the consumers will not be burdened by the government decision to increase central excise duty on petrol and diesel. In fact, the petroleum minister has made it very clear that the consumers will not be burdened. The oil marketing companies will have to bear the cost of a hike in central excise duty on petrol and diesel, and therefore retail prices will remain unchanged. But the big question is that if the crude prices are hovering around $60 per barrel in the international market, when the benefit of reduction in crude prices will be passed on to the consumers. The oil minister has maintained that the oil marketing companies are maintaining inventory, 45 days crude inventory, with the average cost of $75 per barrel. And if crude prices remain range bound in $60 to $68 per barrel, then there will be possibility to decrease prices going forward. Along with that, the Petroleum Ministry has also maintained that the high probability that the prices will remain range bound. There is ample supply in the market. New suppliers have been added to the list, and therefore there is no shortage of crude in the market. And there is high probability that the prices will remain range bound, and oil marketing companies will reduce petrol diesel prices going forward.
Well, absolutely, Prakash, and that's exactly what Oil Minister also had to say, because he said that hike in excise duty on petrol and diesel is not going to be affecting consumers. That's the word coming in from him. Let's also go across and listen into what were the exact words, what did he exactly say when it comes to the excise duty?
Look, international price of petrol came down to around $60 a barrel. $60 of crude per barrel in the last day or so. But please remember that our oil marketing companies, with whose work I'm more familiar, but even the private sector companies, they carry inventories over a 45-day period. And if you go back to, say, early January, the crude price then was $83, which came down subsequently to $75. So the crude inventory that they're carrying is at $75 on an average per barrel. So, but if your question is going forward from here, if the price remains at $60 a barrel as it is today or thereabouts, and I'm not going into the Indian basket or Brent, etc., I'm not going into that, then can you legitimately expect prices of petrol and diesel to be moderated by the oil marketing companies in keeping with the global price? To which my answer would be yes. In a deregulated sector, you can expect them to accordingly adjust the market retail price.
All right, then moving on from the oil and gas space, sources tell ET now that Law Ministry has cleared new provisions related to the Insurance Amendment Bill. Prakash is here again with all the details.
The government is all set to introduce the Insurance Amendment Bill during monsoon session of Parliament, which is expected to be commenced in July. That's an important development coming in. We're given to understand that all preparations have been completed. In fact, there's a wider consensus on almost every issue, including providing composite license to the insurers. In addition to that, sources are also indicating that the Law Ministry has cleared some provisions, including 100% FDI in the sector. In fact, the Law Ministry has vetted the proposal to include 100% FDI to the bill. That's an important development coming in. Some new provisions have also been made to attract foreign investors. Comments received from the stakeholders have been considered carefully. In fact, the Finance Ministry will seek cabinet approval before moving ahead. As you are aware that the proposed amendment likely to bring sweeping changes in the sector, and that include customers, agents, investors, among others. The government is expecting transformative reforms in the sector, and that may ensure greater accountability as well.
Prakash, for that update coming in. Moving on, let's get you some key commentary. Then Motherson Group Vice President Vaman Sehgal says that the strategy of producing as well as supplying locally insulated the company from tariffs. In fact, in an exclusive chat with ET Now's Anjali Palod at the India Global Forum, he also talks about the roadmap when it comes to the next 5 years for the company. Let's go across and listen in.
Motherson actually produces in the US, so we've had a strategy that every country we produce locally, we source locally, we produce locally, we supply locally. So in fact we are quite insulated from some of these tariffs because we're not really exposed in that sense. We're not doing a lot of exports from India to the US or from any other country to the US. Of course, demand will be seen how that impacts the automotive demand globally, but our philosophy of 3CX10, we're trying to have no country, customer or component more than 10% of our business also insulates us quite a bit. And I'm quite grateful for my dad to have that vision to make production locally everywhere where we are. So I think a lot is to be seen, what is the impact on demand, but from the supply side, from our production side, all our sites are pretty secure.
Now, as the financial year comes to a close, how has the year been for the group, and what are your major expansion plans for the year coming ahead?
Yeah, phenomenal. I think Motherson doesn't just go by a quarter or a year. We go by 5-year plans. We've just finished our 5-year plan. So we will be announcing the results of that. And we're now setting the next 5-year plan. And I have to say that these 5 years, of course, with a lot of problems that have been there in the world, but Motherson has done phenomenally well. The team has expanded. We've pivoted from just being an automotive company to multiple new industries such as consumer electronics, medical devices, logistics, a whole bunch of new things that are really coming up in Motherson. So we've pivoted from being an auto component company to a manufacturing, engineering and assembly specialist. And that's why we're getting a lot of inbound interest from a lot of customers who've seen what we've been able to do on the automotive side to also do for the different industries. Of course, automotive will remain bread and butter, but a lot of exciting things coming up in this next 5-year plan, with even aerospace playing a very large part for Motherson in the future.
Fundamentally, what are the new things that we'll see in your next 5 years, and that will be a major shift from how you've done things in the last 5-year plan?
Yeah, so these new industries such as, like I said, aerospace is going to be a large one. Medical is something that we're focusing on. Again, focusing on the manufacturing, engineering and assembly side.
Well, lots of discussions about tariffs at the India Global Forum. Parth Jindal, the managing director of JSW Cement, also spoke about US tariffs and urged the government to allow US automakers in India as they'd struggle to compete when it comes to cost. Now, he also emphasized that for India to become self-reliant, the right technology can come from anywhere, but it's how we use that technology that matters. Let's listen in.
When you're a producer of steel in the US, you definitely smile when you hear about tariffs. Now, if a US automaker wants to come into India, please allow, I would request and I would urge the government to please allow them to come into India without any tariff, because I can tell you for sure they cannot compete in terms of cost. And if India truly wants to electrify its automobile industry and truly wants to become self-reliant, we can bring in the right technology from China. There's absolutely no harm in doing that, as long as you're bringing in technology and you're not bringing in finished products from any country. And as a result, we need to protect those critical industries as long as we are competitive. At the same time, cooperate with them where their technology is the leader in the world so that we can bring the cost down.
Alright, then let's keep it going with commentary coming in from IGF. Then Jay Kotak, co-head, highlighted that over the last 2 years, low-cost deposits have been grown significantly. Also pointed out that gold and real estate also continue to be reliable stores of value. Let's listen into some important insights coming in from Jay Kotak, who's the co-head of Kotak 811. Kotak, in fact.
Over the last 3 or 4 years, low-cost deposits, or certainly the last 2 years, low-cost deposits have not grown very much. And gold and real estate continue, gold particularly over the last few years has continued to be a store of value.
All right, then moving on from the real estate space, Sridhar Sivaraman, investment director at Inam Holdings, is bullish on gold has been bullish on gold for quite a period of time. But the mild correction was bound to happen, he says, as the yellow metal has gone too fast too soon, he believes. Let's listen in to his commentary.
let's accept it. Gold is up almost 50% in the last 1 year, despite the correction that we are seeing. You can't have an asset class keep going up, one way. I'm a big bull on gold, but I'm saying that it's gone up too fast, too soon. So there will be some correction, but over a period of time, I'm still bullish on gold that this is an asset class which will do well, but it can't go up 50% every year. I mean, this is not possible. So that's how I look at it.
And with that, it's time for a very quick breather on the show. When we come back, we'll get more news and updates on the other side, so don't go anywhere. Welcome back. Thank you so much for staying tuned in. Well, all eyes are on the outcome of the two-day monetary policy meeting, where another 25 basis point rate cut is largely being penciled in at this point. Let me go across to Gaurav, who's standing by to tell us what the street is expecting. Of course, growth and inflation is going to be something, global uncertainty as well. That will be on the MPC's radar as well. Gaurav, but at this point, what is being penciled in?
Well, yes. Trump tariff is already causing turbulence in the market, but other than that, specifically in terms of India, we will be watching out on the RBI MPC meeting's outcome, because now around 90% of the surveyed economists believe that around 25 basis point of rate cut is what we can see in this meeting as well. With this, the overall repo rate will go to around 6%, and there are two reasons why economists believe that. First is when we talk about inflation, now they believe that inflation is going to ease down. In fact, the inflation, which was as high as more than 6%, is expected to come as low as around 3.6%, which is the lowest in the last 5 years. Other than that, when we talk about IIP data, we are seeing some kind of slowdown because it is expected to grow at around 3.2% in the month of February. Other than that, what is key thing to watch out for is the RBI stance, because currently RBI holds neutral stance, but some economists believe that RBI will go ahead and change their stance to accommodative, while at the same time others believe that it will be really too early to go to and change the stance, and the reason being that it is currently at a trade war situation when we talk about tariff which are imposed by Mr. Trump, and that is the reason why they believe that RBI will still remain cautious. Other than that, any kind of commentary from RBI in terms of how the growth is going to be is a key thing to watch out for, because at this moment when we talk about India's growth rate, RBI believes that India can grow at a rate of around 6.7% in terms of GDP in FY26. So any kind of change in estimate is something to be watched out for, and any kind of changes in terms of the stance from RBI, and at the same time any kind of changes in terms of the commentary coming up from the global trades which are happening is a key thing to watch out for. But as of now, around 90% economists believe that we will see another rate cut in this meeting of MPC.
That's the word coming in. Apart from rate cuts, commentary on global trade is something that will be key to watch this time. Well, moving on, as the world is in the midst of market turmoil, experts believe India could weather the storm better than most. While tariff tensions rattle economies, some sectors like oil and gas and healthcare may emerge stronger. Now, top voices weigh in on what lies ahead and how they're positioning their portfolios.
The damage to the Indian economy should be less. I'm not saying that will not happen at all. There will be damage if there is, trade barriers. But if we play our cards well, our damage could be less. In most countries, the risks are manageable. With China, I think it's a bit different, and now they've gone into a retaliatory mode, which worsens the situation. I'm not sure how that plays out, so I'll be very worried if I'm a Chinese investor.
We moved out of certain stocks which we knew were going to be impacted by the tariffs in the US. We're also looking at domestic focused companies. So healthcare, and that also within healthcare, basically hospitals is one sector that we are very comfortable with. I think in the immediate couple of quarters, I don't think they'll be impacted by what's happening globally. Coming to hospitality, again, hotels, we are fairly bullish on that. Again, I believe that the next couple of quarters, they should be fairly insulated from what's happening globally, in fact, domestic consumption per se. I think that's going to do fairly okay.
My guess is that if this crisis continues, then we still go back to the old playbook of easy liquidity, fiscal stimulus by the government, all linked to the global, all linked to the domestic segments, and that's what we are betting for. But we will stick to the domestic theme, both the investments theme, which I think should happen in any case over the long term, and the financials theme, which we believe that offers good value.
All right, then let's help you start your day right with some key commentary. Let's also take a look at the impact of Trump's tariff policies, and the word coming in from Devina Mehra, who's the founder and CMD at First Global, talks about how we're now in an uncharted territory when it comes to this entire situation and how it's playing out. Also touches upon the sectors that she has a positive view on amid the severe global volatility. Let's go across and listen in.
We are in uncharted territory, and the whole point is that I do not know what problem is he trying to solve with the tariffs, because the US economy was almost at full employment anyway. The unemployment rate has been very low. So it's not as if that people are not getting work because the manufacturing is getting done elsewhere. So what is the problem that you will solve by putting the tariffs? And debt is a very vague thing, because if you really put brakes on the economy, which is what he's now doing between inflation. Already, I mean, even a month ago, inflation expectations in the US had gone up to 3.5%, and now for the medium term, and now I'm sure it might be higher whenever is the next number comes out. So you are doing something which is just shaking up the economy with no real payoff. I mean, the only reason right now the labor numbers are not looking that great is because of Musk's dodge, where you are firing people right, left, and
which
center.
he may quit soon when the job is done.
Yeah, and the tariffs themselves are not rational. I mean, they are just predicated on the trade deficit with the country, not the tariff barrier of the country. I was reading somewhere that Vietnam had some 5% average tariff, and they've been hit with some 47%. So, I mean, even if they bring that 5% to zero, how is that going to change the 47%?
But, Devina, I mean, I understand that. And there are many, analogies there that this is like the 1920s Great Depression. We don't know whether recession is going to stall here. Is it going to lead to depression in the world? Very recent examples were 2008, 2020, when COVID hit. How different is it this time in terms of what the equity markets are doing?
So equity markets are not that predictable. As far as India is concerned, I do not think you are in high-risk territory. As far as the large, steady portfolio is concerned, small micro caps, it's another story. That's and my stance on this has not changed in I think almost 3 quarters now. So I've been saying exactly the same thing, that get into a steadier portfolio and get out of the frothy areas of the market. And I don't think there is a huge risk, because you had a whole decade of below normal returns in that 2010 to 20 decade, which was that you put in 100 rupees in 10 years, you get 230 rupees when fixed deposits would have given you 200. So that's what created this room for the post-COVID bull run. And still you are not way above the trend line or anything like that on any parameter. So that's the plus for India. So if you were waiting on the sidelines for the last few months saying correction hoga, then I'll invest. So it's time to be invested to the extent of your equity allocation, which should never be 100%. Again, my stance on this again remains unchanged, that no matter how young you are, etc., equity should never be 100% of your portfolio, but whatever is.
Well, that's the market outlook that we are expecting. Now, moving on, let's get you some more news updates. Well, the Crown Prince of Dubai is set to visit India today, where he'll hold a high-level meeting with External Affairs Minister S. Jaishankar and also Defence Minister Rajnath Singh. Now, during his visit, he'll also take part in business roundtable aimed at strengthening economic and strategic ties between India and the UAE. Next up, the US Supreme Court has rejected a plea by Thakur Rana, a co-conspirator in the 26/11 Mumbai terror attacks, seeking an emergency stay on his extradition to India. Now, with this decision, the path is now clear for Rana to be extradited to India and face his trial in his alleged role in the deadly 2008 attacks.
Moving on, Union Finance Minister Nirmala Sitharaman has begun a 6-day official visit to the UK and Austria. In the UK, she'll be attending the 13th ministerial round of the India-UK Economic and Financial Dialogue, is also expected to meet with think tanks, investors, as well as senior business figures. Moving on to the world of sports, then, Kolkata Knight Riders and Lucknow Super Giants will be facing off today at Eden Gardens in the 21st match of IPL 2025. In fact, the game was rescheduled from April 6th due to Ram Navami. Both teams are mid-table with identical records separated only by their net run rate. While in the evening, you also have Punjab Kings host Chennai Super Kings as well. And CSK, of course, is struggling with 3 consecutive losses, while Punjab Kings also come off at a home defeat. Shreyas Iyer's Punjab Kings appear more settled than the misfiring CSK unit. With that, completely out of time on this edition of Market Cafe on ET Now. Thank you so much for tuning in.
If you like this video, then like, share and subscribe to ET Now.